Finding good deals in this market seems to be getting harder as stocks continue to push higher. If you have a lot of cash sitting on the sidelines, or if you are just getting started in investing and you can't stomach the valuations that you're seeing in the market today, this is going to be a great video for you as I cover 5 stocks that are currently undervalued. For each one, I'm going to be doing an overview of their business, a look at their financials and their valuation, and finally, I'm going to be giving them a rating of 1 to 5. 1, making them a very speculative buy, and 5, making them a very strong long-term buy. What's up everybody? Welcome back to my channel where I simplify investment analysis so that you can make an informed investment decision. My name is Aaron, and I hope you enjoy this video and learn something new. So with that, let's take a look at the first undervalued company, and that is the Rocky Mountain Chocolate Factory. Now, a lot of you have probably heard of the Rocky Mountain Chocolate Factory or even been to one of their stores, but you likely didn't know that they're a publicly traded company. And that's not that surprising, seeing as they have a market cap of $25 million. Now, this is exactly the type of stock that you want to look for when you're looking for undervalued companies, because the market cap is so small that it is likely going to be overlooked by major investors, which is going to lead the market to misprice the stock more often than a company like Facebook that is very closely followed by not only the retail market, but also institutional investors. Now, the Rocky Mountain Chocolate Factory is successful for a few reasons. The first is their excellent in-store experience. A lot of the time they're going to hand make the fudge and chocolates within the store, which makes it a very fun and unique experience and brings a lot of people back. The second is the quality of their chocolate. Now, this is very important because if the company's chocolate tasted like doo-doo, I would not be talking about this stock right now. However, they are known for very high quality chocolates, and this gives them a lot of pricing power in terms of being able to raise the prices of their chocolates based on the market conditions. And the third is that their stores are located in heavily foot trafficked areas. Now, why this is important is because the store is very similar to that of Cinnabon, where when you walk past the store and the smell of the chocolate wafts into your face, you just have to walk in there and get some chocolate. Now, when you combine that with the excellent in-store experience and high quality chocolate, you get a recipe for success, and is what has contributed to the company being able to build up strong brand recognition over its years of operational history. Now, the company has over 300 locations throughout all of North America, 98 of which are corporately owned, and the rest are franchise locations. Now, given that a lot of their business was generated from the locations of their stores that were in areas with heavy foot traffic, the COVID-19 crisis definitely had a major impact on the demand for their products. However, they are very fortunate that they recently signed an exclusive distribution partnership deal with Edible Arrangements, who has a very strong online presence and is going to be mitigating a lot of the damage that the company would have otherwise seen due to the COVID-19 crisis. In addition to that, a lot of their stores have done a very good job with curbside pickup in order to keep their doors open and continue generating some sort of demand for their products. Now, with locations opening back up and people being able to go back in public, we're going to be seeing a pickup in their sales again, and a lot of their franchises and corporate-owned locations have been able to weather the storm, so we're going to see the company return back to normal operations within the near future. Now let's take a look at their valuation. As always, I used a net asset value and earnings power value model, and if any of you are interested in using the same valuation method and spreadsheet that I do, I post every single one of the valuations, including the spreadsheet, in my Facebook group for free, which I have included the link to down below in the description. So taking a look at their valuation, we see that they have an intrinsic value of $7.85. And in addition to that, they have a very healthy financial position as they don't have any long-term debt. They just have $1 million in short-term debt and $5.4 million worth of cash to meet any of their short-term liquidity needs. This puts the company in a very strong financial position and is why they are able to weather this storm with the coronavirus, and is what's going to allow them to come back just as strong when this situation is over. Now, moving on to the rating, I'm going to be giving them a rating of 4, and that's because of the strong financial position of the company, the severely undervalued stock price, and the quality of their business. Now, I currently have a position in Rocky Mountain Chocolate Factory. I own 400 shares at an average price of $4.48. However, I am looking to buy even more shares of the company, and I'm looking to increase my position to around 600 to 700 shares in the company. Now, if you've enjoyed this video, hit that like and subscribe button so you don't miss out on any of my future videos. So now let's move on to the second company, which is Eros International. Eros is essentially the Netflix of Bollywood. Now, what makes the Bollywood market so attractive is that most people think that the demand for Bollywood movies is limited to East Asia. However, there's actually global demand for Bollywood movies. In addition to that, India, where this company is based, is the second fastest growing digital economy in the world, second to only that of China. Now, this is going to provide Eros with a massive growth opportunity in the future, and given that they have the largest Bollywood library in the world, This puts them in a great position to benefit off the growth of the digital economy in India, as well as the growth in demand for Bollywood movies around the world. Now, over the past couple of years, Eros has been dedicated to building strong partnerships with some of the biggest tech companies in the world. Some of these include Apple, Amazon, Microsoft, Jio, and Xiaomi. Now, these are just 5 of the companies, but if you take a look at their press releases over the last couple of years, you'll see that they've built partnerships with tens of companies around the world. Now, their strategy currently is to distribute their content for a very low cost through a lot of these partnerships that they formed, and eventually they're going to be monetizing those users either through advertising or by increasing the subscription price of their service. They currently have around 26 million paying subscribers and 123 million users. This provides them with a very large competitive advantage as they are able to distribute their product and build up their brand as the Netflix of Bollywood. Now, in addition to that, they just announced that they're going to be merging with STX Entertainment, which is a privately owned entertainment company based in the United States. And this is going to provide them with access to much cheaper capital and is going to allow them to expand their service offerings and improve their platform. Now, as we know, mergers can be very difficult for companies, especially when you're merging 2 companies from separate cultures. So this is going to be one of the risks to watch out for. However, I believe this is going to be a very successful partnership for the 2 companies, and in the end is going to boost the market value of Eros. So now let's move on to look at the valuation of the company pre-merger. So the intrinsic value of the company was $4 per share, and actually as I'm shooting this video right now, the stock price is up 12%, up to $3.60. So we can see that currently the stock price is very close to that of its intrinsic value. However, since the company is very well positioned to benefit off the growth of the digital economy in India and the recent partnership with STX Entertainment that's going to provide them with access to cheaper capital, it is likely that Eros' intrinsic value is going to continue to grow over the coming years. So now taking a look at their financial position, we see that they do have $89 million of cash and $200 million of debt. However, as we said earlier, their merger with STX Entertainment is going to provide them with access to cheaper capital. So this current capital structure is going to be changing in the future. Now moving on to the rating, I'm going to be giving Eros a rating of 3, given that the upcoming merger provides investors with a solid amount of risk. In addition to that, the stock price is trading relatively close to the intrinsic value, not providing you with a very solid margin of safety if you do want to buy the stock right now. So for that reason, it's more of a speculative buy than Rocky Mountain Chocolate Factory. However, given the strong growth potential of the company, it is not entirely a speculative bet, as the company does have very strong value proposition. So now let's move on to the third company, which is The Gap. Now this might surprise you that The Gap is included in this list, and likely the only thing you've heard about Gap recently is that they signed a deal with Yeezy in order to be a distributor for Yeezy products. Now The Gap has 3 main stores that generate most of their revenue. The first is Old Navy, which is their discount retailer. The second is The Gap, which at this point is an iconic brand synonymous with the United States. And the third is Banana Republic, which is a quasi-luxury brand. Now during recessions or market downturns, these types of cyclical companies tend to not do so well. However, Old Navy, which is their discount retailer, represents around 45% of their sales. And historically, discount clothing retailers do relatively well compared to the rest of the market. So this is going to provide them with a little bit more stability than that of their revenues coming from Banana Republic or The Gap, which are a little bit more pricey. Now they also own these 4 other brands, however they represent a relatively small portion of their revenues. So for the most part, when you're looking at The Gap, you want to focus on Old Navy, The Gap, and Banana Republic. Now some of the risks facing the company and the reason why they haven't been doing that well in the past couple of years is that they're facing increased competition from discount retailers such as Zara and H&M. However, they are currently focused on revitalizing the Gap brand. As you can see, they're currently restructuring the locations of their stores in order to make it more of an exclusive brand. Now, in addition to that, as I said, they signed a deal with Yeezy, which to me shows that they know what it takes to remain relevant and is going to be a positive for the company in the future. Now, whether you like or dislike Kanye, the one thing that you do have to give him credit for is that the guy knows how to generate demand. As we've seen, Kanye's entrance into fashion has absolutely shaken up the industry, and it's going to be extremely beneficial for The Gap having exclusive rights to his products. Now moving forward, taking a look at their valuation, I also use a net asset value and earnings power value model in order to find the intrinsic value of $30 per share. Now given that the stock is currently trading at around $12 per share, you're getting an over 50% margin of safety on your purchase price of The Gap. However, if you are purchasing The Gap, you should be aware that the company did run a loss in the most recent quarter due to the effects of the coronavirus. However, given the strong history of the company, I believe they will be able to return to profitability and continue producing the same results they have been over the past 10 years. Now, taking a look at their financial position, we see that they don't actually have that much debt. They only have around $1.3 billion worth of debt. However, where the big financial risk comes for the company is in their operating leases, where they have $5.4 billion worth of operating leases. A lot of these are leases for their stores, and this is why the company ran a loss in the most recent quarter, as they weren't generating any demand from their stores and had to rely purely on online sales. Now, taking a look at the company's revenues and operating profits over the last 10 years, you see that there hasn't really been any growth in either of them. So this is probably going to continue on into the future, and for that reason, it's not a stock that I would want to be holding for the long term, but rather it's a stock I would be buying while it's undervalued and selling once it reaches its intrinsic value. So now moving on to the rating, I'm going to be giving the Gap a rating of 3. And the reason why I'm giving them a rating of 3 is because they haven't had stellar operational results in the past, and it's likely going to take some sort of catalyst to get them back up to their intrinsic value. So for that reason, you might not see a return on your investment right away, but over the long term, it is likely that it is going to revert back to the mean of their intrinsic value. Now let's move on to the fourth company we're going to be taking a look at, which is Mineral Technologies Incorporated. Now this, similar to Rocky Mountain Chocolate Factory, is not a sexy company, and it is going to be overlooked by most retail and institutional investors. It has a market cap just over $1 billion. As such, it's not really targeted by many analysts or retail investors or traders. Now, Mineral Technologies, as their name suggests, makes specialized minerals that meet the requirements of a wide variety of markets. Now, they serve over 12 markets that range from kitty litter all the way to water treatment. So this company has a very wide range of products that they offer to the market. And in addition to that, something that's very beneficial for the company is that they are considered an essential service. So for that reason, throughout the entire COVID crisis, they've been able to remain operational and continue to generate revenues and profit for their shareholders. This is very beneficial, and it's very surprising that this company has been overlooked by many investors, and for this reason, they provide a great investment opportunity. Taking a look at their valuation, for which I also used a net asset value and earnings power value model, we have an intrinsic value of $69 per share. Given that the company is currently trading right around $45, you're getting a 33% margin of safety on your entry price of Mineral Technologies Incorporated. In addition to that, looking at their financial position, they aren't carrying very much debt. They have around $900 million worth of debt, and given that they have very stable operating profits of over $200 million, that gives them an interest coverage of over 3 times. So for that reason, this is a very strong and stable company for you to make an investment in. They have an excellent financial position, they are undervalued, and they are an essential service that is able to continue operating throughout the COVID situation. Now we can even take a look at Moody's recent rating of their $400 million debt raise. They say that the outlook for the company is stable, which should provide you with even more confidence in purchasing the stock. Now moving forward to the rating of the company, I'm going to be giving them a rating of 4, given the strong operational results, the fact that it is an essential service, and the strong financial position that the company is currently in. So now let's move on to the fifth and final company that we're going to be taking a look at. And this one might surprise you a little bit that it is still undervalued, and that is Google. Now, Google is my absolute favorite stock in the market. I think they are going to be an excellent stock to have in your portfolio, and I actually think it's a mistake to not be owning some Google within your portfolio. And actually, even Warren Buffett said a few years ago that not buying Google was one of the biggest mistakes that he made, and it was a very big oversight on his part. Now, it might surprise you that Google is still undervalued. However, they do have over 90% market share of the search industry, and in addition to that, Google has just become synonymous with the word search. Now, they are the #1 online advertising platform, giving them a lot of power within the market, and they're a naturally occurring monopoly with very strong prospects for the future. In addition to that, taking a look, YouTube has over 1 billion users, Gmail has 1 billion users, and they provide a lot of productivity software that competes with that of Microsoft, like Google Sheets, that competes directly with Excel. So Google is definitely a company that you want to be buying stock in for the foreseeable future. And honestly, when you buy the stock, I would not sell it for 20 to 30 years because this company is going to be around for a long time and will continue to generate above average profits for the foreseeable future. Now, taking a look at their valuation, I couldn't use a net asset value and earnings power value model for them because it doesn't account for growth. So for that reason, I had to use an earnings power value model which included growth. This led me to an intrinsic value per share of $2,100 per share, and given that they're currently trading at a price of $1,500, you see that the stock is currently undervalued. Next, taking a look at their financial position, they have over $100 billion in cash and marketable securities and only $4 billion in debt, which means that they could just pay off that debt and not even make a dent in their cash and marketable securities account. So Google is financially extremely healthy. They have excellent operational results, and they have extremely strong barriers to competition, which is going to allow them to continue generating above average returns for their shareholders. So this leads me right into the rating, and I'm going to be giving Google a rating of 5. I currently own Google at $1,300 per share, and I'm going to be adding to my position in Google any chance that I get. And I recommend that all of you who are just beginning to invest or are looking to deploy a little bit of extra cash to be investing in Google. So that does it for this video. As a quick recap, we're going to take a look at the ratings for each of the companies. The first company we looked at was Rocky Mountain Chocolate Factory, which I gave a rating of 4. Next, we took a look at Eros, which I gave a rating of 3. After that, we looked at Gap, which I also gave a rating of 3. Next, we had Mineral Technologies Incorporated, which I gave a rating of 4. And finally, we wrapped it up with Google, which I gave a rating of 5. As always, I'm not a financial advisor. These videos are for educational purposes only. However, I hope you enjoyed and learned something new from this video, and I look forward to seeing you guys in my next video. Have a great week.